I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guests on today's show are Rob Small and Anil Seetharam, managing directors and founding members of the Stockbridge team at Berkshire Partners, a $5 billion concentrated public equity manager that sits inside the $20 billion private equity firm. Unlike many public equity strategies at private equity firms, Stockbridge works closely and collaboratively with Berkshire's private equity team on its investment research and has attracted an enviable client roster of some of the most respected allocators in the world. Our conversation covers Rob and Anil's history at Berkshire and the steps they took to launch Stockbridge in 2007. We discussed their collaboration with Berkshire's private equity team, investment criteria, deep dive research, decision-making process, portfolio management, board involvement, management of stock volatility, sell decisions, mistakes, and lessons learned over the last 17 years. Before we get going, here's a shout out to all the investor relations and business development professionals. Your role is one of the toughest in the industry because unlike in many other industries, the functions of marketing, sales, and customer relations rarely drive purchase decisions in investing. It's often hard to know how to move the ball forward when allocators are busy and opaque about their process. So we decided to create a Capital Allocators University experience just for you. On December 3rd and 4th in New York City, I'll be joined by your peer and superstar Rahul Mudgal, branding expert Jen Prosek, founder of Prosek Partners, conference wizard Ron Biscardi, founder of iConnections, and investment leaders Sarah Samuels from NEPC, Dave Moorhead from Baylor, and Shannon O'Leary from St. Paul, Minnesota Foundation, to help you learn best practices for understanding allocators, developing relationships with investors, and building a brand through workshops and peer discussions. You can learn more and sign up to join us at capitalallocators.com/university. Thanks so much for spreading the word about our newest Capital Allocators University course for investor relations and business development professionals. Please enjoy my conversation with Rob Small and Anil Seetharam. Rob, Anil, thanks so much for joining me.
Glad to be here.
Glad to be here.
Why don't you take me back to both of your backgrounds leading into what became this public effort?
I graduated from Penn. I worked at McKinsey in consulting for a couple of years and then started at Berkshire Partners actually as an associate on the private equity side of the house. So did that for 2 years. Never actually worked with Rob while I was a private equity associate, and then left there and went to a firm I think you know quite well, Ted, a firm called Reservoir Capital in New York for 2 years, where I did a little bit of everything across public and private. And then in 2006, Rob and a couple of the other partners at Berkshire reached out and said, hey, we're thinking about starting up a public equity effort. We'd love for you to come and join. And the rest is history. I joined in 2007 and have been here ever since.
Rob?
Yeah, I joined Berkshire Partners right out of business school back in 1992 and spent the first 15 years here focused on private equity. That was what Berkshire Partners did at the time. And before that, I graduated from Yale University, spent a couple years consulting at Bain, and then went off and got my MBA at Harvard.
So what was it that led Berkshire Partners to decide to get into public equity?
A couple of things happened. First, we always thought that potentially doing more things might make it a more stable business, and bringing more people in that were interested in looking at businesses and thinking about businesses and being smart about businesses would help the firm in general. But we noticed in the period before we started, so 2005, 6, 7, prices in the private equity market, largely fueled by easy ability to get high leverage, started to go up. For the first time, we did comparable sheets with public companies, and we were seeing private companies go for more than public companies. So the control premium was higher than the liquidity premium. And we started to scratch our heads and say, maybe there's an opportunity that a lot of the companies we've looked at over the years have gone public and doesn't make them really different companies. Why wouldn't those be good investment opportunities if they're potentially cheaper? The one thing we didn't know was whether we could get to conviction on public-only information. So we figured the way to do it was to try, and we put some money together among the partnership and tried with our own money at first.
How did you think about what makes sense to add as a product?
I think first on a big picture, we looked at a few things over the years. We held everything we looked at to 3 major tests. One, was there true synergy with private equity? Did we think both sides would be better for being partnered with the other? Second, did we something that we thought our history and our skills would give us a chance to be pretty good at? And then third, was it a place we wanted to invest our own money? We're the largest investor in our private equity funds, and we're also, as a group, the largest investor in Stockbridge. So we like to have the mindset of we're investing our own money alongside our partners. And so if it passed those 3 tests, and we thought this did, we thought it was worth a try. And then the key was, did we think we were getting to conviction on the names we were looking at as we started to build a portfolio and build a team and have some evidence at least that that conviction was well placed. And when we got there, that's when we decided to open it up to others.
So if you go back 20 years, you weren't the only private equity firm that thought of adding a public market effort. And many of those didn't work. The mentality of the private equity managers just didn't seem to mesh with what was happening in public markets. How did you go about it so that you could create those synergies?
We did 2 things. First, we went around and talked to everyone and tried to understand why people succeeded. And there were a few successes, I think, in the market where people had done it well and why people had failed. And you're right, there seemed to be a lot more of those. One thing that came to us is that building it internally was important because the relationships of the people were key to making it work. It wasn't just saying, geez, Berkshire Partners should have a public firm. Let's go hire a team to go do it. That would not get the collaboration that we would need. So doing it internally was one key thing. The second thing was trying to do what you thought you could be good at as opposed to trying to understand what the market wanted in a sense, which may seem backwards. But when we were doing it, there weren't a lot of long-only funds, and we're essentially long-only. We have a right to short, but we've done it only a couple times in our history. And the market at that time didn't really want to have long-only funds. They wanted to have people who were going long-short. And so we spent some time understanding whether we could short or whether that made sense. And we decided, A, we were unlikely to be good at it because it seemed like very, very few people were good at it. And it took up most of your time to get shorts. Plus, you were in some ways leveraging your longs in order to justify your shorting. So it just seemed to us to make no sense to do that. We were fortunate in this process to have David Swenson, the CIO of Yale, be a mentor as we were building this. And his advice, which we definitely live by, which was do what you think you might be good at. That's how we came to our strategy, which was long only and concentrated.
How did you build up the muscles of everything that goes into public market investing with private equity background?
One of the things that we were pretty fortunate in 2006, 7, 8 was that there were a few former Berkshire folks who, by coincidence, were at a point in time where they were looking to do something different. And a couple of us had public equity experience, including John Meyer, who's one of our partners, had spent a few years at Fairlawn investing in the public markets. And he had been a Berkshire private equity associate, similar to me, from 99 to 2001. So it was bringing folks with deep private equity experience and marrying us with former Berkshire private equity associates who had a lot of public equity experience together. What was also pretty fortunate is, despite the fact that our careers had taken very different paths. Everyone had arrived at the same conclusion, which is what we were trying to do at Stockbridge was the right way of investing, which is concentrated, long-term, long only. One was assembling a team which was pretty aligned, both from a cultural standpoint and also had similar view on how to invest in the public markets. And then it was a good amount of trial and error. For the first 2 years, I think we invested exclusively internal capital and tried a lot of things. So like Rob mentioned, we tried to short. The first short, I think, lasted a week. And we realized we were not going to be good at it. We didn't want to do it. And we've largely not done it since. We tried investing in shorter duration things and realized that we didn't think we could do that well. And we tried investing in different kinds of businesses. And we realized, look, we really like long-term winners. Getting better at this business is an ongoing process. But the first 2 years were really built around developing a team, a process, an approach we thought we could execute against.
The other thing that I did right away is I went to a behavioral finance course, which was fascinating. So at least I could learn about some of the mistakes that you're likely to make in the public markets. There's not a lot of behavioral finance issues. In the public markets, every day you have a choice, and that creates some emotional things that you have to learn how to work within.
One other thing Rob mentioned earlier on was how to get to conviction, because the private equity business, the way it works is you have access to a data room and you have a certain amount of time to understand as much as you can about a company with full access to the information and the management team. So if you were to use an analogy of a puzzle box, they hand you the puzzle box and put a clock next to it. In the public markets, they hand you a puzzle box, take about 90% of the information and throw it into the woods, but don't put a clock next to it. And so understanding how to get enough puzzle pieces together that we can get to the same level of conviction in the public markets that we could in the private markets. We're trying to paint the same type of picture in our private equity business as our public equity business. We just have a different process to go about getting it. So part of the muscle building was, can we do that? And one interesting acid test was pretty early on. There was a business that we were invested in at Stockbridge, a company called Skillsoft. It's an education software business that Berkshire Private Equity ended up taking private. And we got to see what public information would allow us to understand about the business and compare it to what private information would lead us to understand about a business. And that led us to the conclusion, hey, actually, we can understand a lot about this business. We get pretty close to private equity style conviction with outside work and access to all of the resources we have at Berkshire Partners in a public setting compared to a private setting. And so that was one of the proof points along the way that we're not flying blind here. We can actually do really good work that's comparable to what our PE business does.
I'd love to dive into that aspect of the process. So you saw these two side by side, and there is a level of diligence you're accustomed to from private equity. Where are the gaps in between the two?
There's a lot of things you just can't know. So for instance, if you're looking at a retail business, what are the store level economics at a store by store level? If you're trying to assess a management team, getting a lot of time with different managers at every single level. What you can do with time and creativity is infer a lot of things. Most public companies do give a good amount of disclosure, and you're able to assemble with a lot of extra work a general picture. So what we're drawing is inferences, but we don't have the actual data.
I like Anil's analogy on the puzzle box with private equity and the clock. And with the clock, sometimes you have to prioritize. What we found, and the Skillsoft thing was fascinating, is that the outside in is just as telling in many ways. And so I think that's been one of the synergies for private equity is they've been able to add some more outside in that we help with on different ideas and different insights that help you know what to look for with the inside data. And if I had to ultimately sum it up, I would say that on a business that's going to continue its basic strategy and continue doing what it's doing, and that's really what we look for in most cases, someone that has a long march ahead of it that looks to be successful, the conclusions end up being pretty similar. The private data would be great if you had an enormous change thesis. If you thought management was doing the wrong thing on major operational issues and you thought you could do better, I don't know how you make that decision without internal data.
How does that work day to day as you're doing diligence on a potential investment?
We work collaboratively both within Stockbridge and then across the firm. So across the firm, we chose not to have any walls between the two businesses. It requires us investing in compliance. And fortunately, I think our team members have embraced that on both sides of the firm and being educated and being mindful of the fact that we want to get nowhere near any lines. But we're not looking for information, we're looking for insights. And so that's good. The private equity side is divided into industry teams. We put one of our people on each one of their industry teams so that way they can learn about what they're learning about the industry. We have access to each other's investment packages. We certainly have one contact database for the firm, and we can use those. And we use the investment history over time, and can everyone invest in each other's businesses? So there's all sorts of conversations of just trying to think about what are the trends and what are driving different businesses. Within Stockbridge, we assign a team to every opportunity. There's usually 2 managing directors on each team, along with a principal. Looking at an idea, occasionally it's 1 and 1, but we work collaboratively, and then we push everything through a Monday meeting. And so we have a package of material that goes out on Friday, and we discuss all the different investment opportunities on Mondays. And that's who ultimately, the whole investment staff is in there, and the whole investment staff ultimately approves investments.
When you bring up the Skillsoft example, it's a public company that gets taken private by Berkshire. How have you navigated the potential conflicts on the public side?
There's a few levels to this. Number one is what we discovered pretty early on is the private equity business. It's not a source of information, given how we're investing in very long-term theses. What we've learned through our private equity business and the 30 plus years of investment activity they've had across hundreds of different businesses is insights into industry trends, into business models, things like that. And so the fact that what we're looking for is insight over long periods of time tends to keep us in a pretty good place from a conflict standpoint. Berkshire Private Equity tends to invest in smaller businesses, has always invested in smaller businesses than we tend to invest in. So there's very little direct overlap in the companies we're looking at. So we found it's extremely rare that we end up with MNPI on a company. And the places where we've run into issues, they've tended to be opportunities, not conflicts or issues. We've co-invested in things. And so what that has led to is an investment that makes sense for Berkshire Private Equity and for Stockbridge has tended to be an investment we make together. And so we've had a number of those over a long period of time. The fact that we can profit together has resolved a lot of the internal conflict of interest that might crop up.
You've alluded to a couple of different aspects of Stockbridge, concentrated holdings, long-term. As you look across a very large universe of public companies, all this information of thousands of private businesses that Berkshire's owned over the years, how have you filtered what it is that you're looking for in investments?
We ask ourselves a few questions. First, is a company that we can understand? Is it in a business or industry that we have some ability to do analysis on, or are the trends that are going to drive the ultimate result knowable? So we don't invest in things like, is the drug going to be approved, or where commodity prices will ultimately drive the answer. Then after that, we look for long-term winners. And we define long-term winners as some mix of stability and growth. And so how do we answer that? First, we look for, one, is there a secular tailwind in the industry? We've found that it doesn't have to be a huge growth factor, but there can't be negative growth. If a business is shrinking, it's really hard to make money. Second, we ask ourselves, is the company well-positioned within that industry? The best thing we can see is that if they have some level of pricing power, if they could charge their customers more and their customers would still want their product, that's a really good sign. But we do a ton of analysis around that. And then finally, is the management team able to execute on the plan? And we found that managements are really good at executing, continuing to do what they have done in the past, and that you have to be really, really careful before you're asking a management team to do something different. So that's the hardest thing to judge from the outside, but we work really hard to do it. And after we've done all that, then we look at valuation. We build a 5-year model, which tends to make you have to think at least 10 years out because someone's going to buy the business from you. And we want mid-teens or better returns.
When you layer those four criteria on, typically you think about a business you can understand with some stability or tailwinds and a good management team. It leads to a high price. You mentioned earlier that you were accustomed in private equity to doing all this work and then having to pay a little more than you wanted to. How do you think about that valuation when it can move around so much more in the public markets?
The market defines expensive typically as a high multiple of current earnings. We don't buy into that breakdown of value versus growth versus different things. One of our investors said to me, if you believe that you're getting mid-teens returns over a 5-year period or better on high-quality businesses, you're a contrarian thinker and you're buying value. That is really good value if you can get that. And that's what we believe, and that's what our history has shown. So we don't think of earnings or as expensive as over current earnings. We think of expensive as what it will be over time. So we have a mix in our portfolio. Some things would screen as quote unquote value. Some things would screen as expensive. All our things we think give very solid returns for what we're looking for.
As you go and do the work on portfolio companies and try to get from what a public investor might commonly have to something that you hope is closer to what a private market investor gathers in information, what does that work look like, both in terms of time and that extra bit beyond what you think another public investor might typically do?
One interesting thing about our firm, just to give you a sense, is when we invest in companies on the private equity side and the public equity side, when we have joint investments, we'll share the same material to both sides of the house because they're making independent decisions about a company. You don't know who wrote that material because it looks the same. It's presented the same. The standard of evidence is the same. The way it's written, how we look at the world is the same. And so there isn't a Stockbridge carve-out for what we look for in a business or a private equity carve-out. We try and spend a lot of time and get to conviction on the key questions. And so examples of things we do. Very early on in our history, we looked at a business, at the time it was called Pediatrics, that staffed 25% of the NICUs in the United States. And we built a model of the demand for neonatology over a 10 to 20 year period based on why were preemies being born, why were babies being admitted to the NICU, and what were the drivers of that over a 20-year period. So very detailed demographic analysis over a long period of time. We own a business today called Vulcan Materials, which is an owner of quarries, aggregate business around the United States. And it's a business we've looked at multiple times over the years. And one of the things we've done is assembled a database of every single quarry in the United States and what the ownership is of that quarry and the population trends around that quarry. So to understand the growth and competitive dynamics around every single quarry in the United States and how those have shifted over 10 to 15 years. So those are the kinds of work we do, and that's what we do on every investment. We don't have a good sense for what other firms are doing, and we don't really share our work with other firms. We share a lot of our work with the management teams that we invest with, and they seem to find that it adds a fair amount of value to their internal thinking. So whether we're on a board, we share the work with the management teams, and even when we're simply passive outside investors, we're sharing our thoughts with them. And we found that the level of work, the long-term nature of our thinking has led us to have very, very good productive dialogues because the management teams think that they're talking to similar-minded, very well-informed, long-term partners.
The only thing I'd add, Anil, is the process starts with just simply understanding how the business works. We really want to get into what do they do, how well do they do it, who are they compete against, who are their customers, who are their suppliers, what are their unit economics, as much as we can just to get a base understanding, because we found that has been really good in answering the key thesis questions. So we spend a lot of time just getting up to speed about a business.
When you're spending lots of time diving into any one idea, and you have this big universe of potential opportunities, I'm curious what your quick criteria is on doing your diligence and moving on to the next opportunity when you're building one of these very, very large models of every quarry in the country.
We followed the acid test that Rob articulated, which is it a long-term winner? Can we understand it? And is it cheap enough? And we're cycling through those very, very quickly. And so one of the things that the scarcest in our business is time. And so we've been doing this for 17 years. I think that's a muscle we've refined fairly well over time. And the reason for putting something down falls into one of those buckets. We look at hundreds of things a year at various levels of depth, and we only allocate that full diligence exercise to a very small handful. We track this fairly closely. We invest in 2 to 3 things a year. We probably look deeply at 10 to 20 things a year with a pretty big team. And so the several hundred that we look at over the course of the year, we're putting them down very quickly for one of those reasons.
It's one of the hardest things about investing. We've been trained our whole lives to try to get to answers. And so when you start looking at a problem, you want to get to a yes or no. We try very hard to only invest in things that we have high conviction. Our no is not that this isn't going to be a great investment. It's that we're not going to get to high conviction that this is going to be a great investment. And that makes it a little easier. We have passed on many things that have turned out to be great, but the goal is to only let things in that will be great.
How do you ultimately decide what goes into the portfolio?
As a firm, we're very consensus oriented. That's been our history on the Berkshire Partners private equity side, and we carried that through to Stockbridge. So as an entire group, we discuss every idea that's making its way into the portfolio. From a very early stage, which we call our tear sheet stage, where we're just introducing the whole team to the business, to a final investment memo, everybody from the newest analyst to the most senior partners is weighing in on that decision at that investment meeting. And the group will vote on whether it should be admitted to the portfolio or not. It served us really well as a firm to have that process. We think many engaged minds thinking about a company deeply over a long period of time leads to a better investment decision. And for some of our more junior team members, it's more of an apprenticeship, so they see that process happening. And obviously, the older and more experienced you are, the louder your voice is in that room. But insight comes from a lot of different places. We want to make sure that if someone has a deep insight, they have the ability to share it. That's a process we've carried over from Berkshire Private Equity. What's very, very different is just how do you decide how big something is in a portfolio? In private equity, the size is somewhat predetermined. The company needs X $100 million of capital. But in public equity, that tends not to be the case. And so we can choose for a company to be 5% of our portfolio or 25% of our portfolio. And we have a different portfolio management process, which we had to build early on to separate the investment decision-making from the portfolio management process.
Portfolio management is probably the part of the process that has evolved the most over time and continues to evolve. On the diligence side, we push incremental improvement and we try to get better. And I think we do get better each year, but the increments are smaller. On portfolio management, way back when, we probably had this view that we would be like private equity, buy a chunk of stock, look up 5 years later, check the price, and sell it. Public market doesn't work that way. And frankly, it gives you more opportunities than that. So we've developed over time. We were religious about keeping our 5-year internal rate of return models up to date and trading off that. The higher the IRR, the bigger the position. We learned that wasn't the best way. We changed over time at that point to adding a conviction element. And we did that in an interesting way. We had noticed that we did all this diligence on all these companies, but we had no way to take that diligence and put it into action. You'd get a drip of either good or bad news about a company and what drove you to make the position bigger or to get out of a position. And we were, frankly, at the beginning, more concerned about getting out of positions. So we added a conviction poll quarterly or 3 or 4 times a year, typically trying not to be around the emotion of earnings, of polling the group, of rating absolute and relative conviction among the different names with and without price, really trying to get questions to surface about which companies do people have doubts in or which should we do more work on. And what we found out of that, not only did it identify the bottom end of the portfolio, there was a huge amount of consistency at the top end of the portfolio. And so we realized there were just companies or businesses that we had higher conviction in. And the logical conclusion to us was maybe we should make those larger positions. So we started taking conviction into account when we were doing position sizing. We continue to evolve, and currently we have a minimum position size. Even though we have seen over our history that conviction can build over time, if you have a low bar at the beginning, things sneak into the portfolio and your time gets diverted and you let in some things that you probably wouldn't let in. Then we make the decisions about whether to supersize them because of the opportunity in front of it or the conviction level. And occasionally we will shrink on its way out in some ways due to valuation. And so that ultimately leads to a portfolio of typically around 15 names. We've had a position become up to a quarter of the portfolio. That's more the exception. Typically, the largest position will be in the 15%, and then a bunch of things around 6%.
Rob, in your early studying of behavioral finance as you were getting ready to invest in the public markets, what did you learn that allowed you to drive consensus decision-making when often that ends up being a lowest common denominator?
Yes, that's definitely a fear that we've always had in our system. Is a lot of investors very much look for, is there one person making the call? I had grown up in private equity side where that was completely not the way it worked. And I thought we made really good decisions. We've designed our product to be consistent with that in many ways. I think if we were a fast twitch hedge fund making multiple decisions every day on trading, it wouldn't work. You'd need single points of decision, whether there's a number of them or one of them. But we don't make a lot of decisions. We've actually designed our process and we keep pushing our process to make fewer decisions, but have them be more well considered. We have consensus on the basic type of sub-businesses we're looking for. And so there isn't that level of argument. It's does this fit and why? And we have respect for each other, both enough respect to challenge each other, but also have some respect to listen to each other. And I think that's ultimately worked for us. I know it doesn't work for everyone, but it works really well for us.
Once you own a name, how have you thought about the cost benefit of going on a public company board?
What we've learned over time is we're not trying to go on a board to change what a company is doing. Across the firm, we're very, very collaborative and we partner with management teams. So we think even at the Stockbridge side, we're best on boards when our role is to help the management team achieve with the company what they're setting out to achieve. We think it's hard, lonely, and not very fun to be in a conflict situation with the management team where you're trying to change something that they or the board are trying to do. So the key is if we have a problem with the company, it's better for us to sell than it is for us to go on the board and try and change it. And we've been pretty fortunate with the boards that we've been on that what they've done is they've increased our conviction in the underlying goodness of the company, the management team, and the thesis. And what we're looking for when we go on boards is, do we think this is a situation where we can add value to this management team because of the unique skills that we bring, given our board experience and our connection to Berkshire Private Equity? And do we think being on this board is going to help us maximize our profit opportunity because it'll help us build conviction, it'll keep us around for longer, it'll help us own things that may seem more expensive, but open our eyes to the opportunity that exists at this company. Those are typically the tests. Boards are a big investment of time for us. And so it's not something we'll undertake willy-nilly.
I'd love to talk about some examples of some of these companies that you've held for a while. I know there are a few that have gone back and forth between ownership in the public markets and the private markets at Berkshire. Maybe dive into one or two of those.
I sit on the board of a company called Advanced Drainage Systems, a wonderful company based in Columbus, Ohio. Berkshire Partners invested in the company in the late 80s when it was a small agricultural plastic pipe producer and held the business continuously until 2010 through multiple funds, and then sold it to another PE firm who took it public in 2014. And the investment thesis has been the same for 35 years, which is that plastic pipe is taking share from traditional concrete solutions because they're cheaper and faster and better to deploy than the incumbent solutions. And because of things like climate change and increasing regulation, the need to deal with stormwater is going up. So the need to just manage water runoff rather than let it just flow into the environment is increasing. So you have this double tailwind, increasing demand for the product and increasing substitution of traditional solutions with plastic pipe. And that was the investment thesis from the 80s to 2010. It was the investment thesis when we, Stockbridge, reinvested in 2015 when it went public. We held it for 9 years. Along the way, the business unfortunately got into an accounting restatement, had a management team change, and those two opportunities created a really interesting opening, both from a valuation standpoint and from our ability to help the company standpoint for both Berkshire Private Equity and Stockbridge to significantly increase our stake. In 2017, we bought about 20% of the company after they were through their accounting restatement and then subsequently joined the board. And with the underlying thesis that we loved the business model, we loved the tailwinds, and that the new management team could really drive significant ongoing growth and improvement in that business. And it worked pretty well. But that's an example of a business where you wake up decade after decade after decade, and it's the same thesis because it's just a long, slow-moving trend you can bet on, which gives the firm across public and private multiple chapters to invest in that company.
I do think it's interesting that on our board positions, which there have not been a lot of over history, each time it was not a part of our investment thesis. We had made the investment. We had interacted with management. We had shared our work. We had had a dialogue with them. Then ultimately, we went on to the board. And when we're on the board, we certainly, and I think fortunately for the company, do not try to manage the company. We are not managers. We are advisors and cheerleaders and help bring resources if they need it. But the management teams manage. We're just an aid. But as Anil said, it does give you a front row seat. And a front row seat in your best companies can be really good to building conviction. An example of that is TransDigm. TransDigm first became known to the firm ages ago when it was founded, and one of my partners was section mates with the founders in business school and had an opportunity and passed on the deal to look at it back in 1993. In 2003, after 2 periods of private equity ownership, our private equity side, which I led a team when I was working there, on looking at TransDigm, and we ultimately lost the auction to Warburg Pincus, who bought the company and took it public in 2006. I had remembered it as probably my most disheartening loss in private equity and one of the best companies I had ever seen. On all 3 of the criteria I talked about, the secular tailwind of aerospace, the position of having parts that were crucial to an airplane on long-lived airplanes, and finally in a management team that executed incredibly well. And so when we started Stockbridge, that was the first company we looked at and we invested. It has become and been our largest position through most of our history. And at a few times during our history, there's been significant disruptions in the stock. And our private equity side has been able to take advantage of some of those by investing alongside us in the public stock. We invested in 2007. I joined the board 3 years later as Warburg was selling down.
So inevitably, when you have these long-term holds, and maybe even when you're on the board, things don't always go smoothly, even slow-moving, successful businesses. Curious how you've tackled some of those challenges, knowing that you want to be a long-term holder. Maybe the long-term thesis is still intact, but somewhere along the way, there's a significant bump in the road.
Every company we invest in has a bump. There are very few businesses, or at least I've yet to see businesses that are a straight line forever up and to the right. We expect the bumps, and we've tried to set ourselves up to take advantage of the bumps. So the obvious thing that we do is when a bump hits, we do a very quick look. Hopefully we've done enough work to be able to put it in context and understand it, but we'll do a lot more work. An example of that was in 2016, I believe, TransDigm had a short attack. A number of shorts came out with allegations against the company, and the stock reacted strongly. And we quickly talked to the company, but we also did all our outside-in work as well. We didn't want to rely on the company. We thought we would do a ton of work. We interviewed priors. We did all sorts of things to try and see if there was any sniff that we had gotten it wrong, because you have to be prepared to be wrong. And we found that wasn't the case, so we were able to buy more stock at that time. So it turned a problem into an opportunity because it wasn't a real problem. Same thing happened with COVID for TransDigm. The biggest risks to TransDigm, who serves the aerospace market, is that people stopped flying. We weren't creative enough to figure out that COVID was coming. But when COVID came, we did the work. We spent a lot of time trying to understand what their liquidity profile was, whether the leverage was handleable, and came to the conclusion again that because the business is more diversified than meets the eye, although it's all in the public disclosures with defense and freight and business aircraft, that it was going to get through the period and that people would want to fly again. And so again, it created an opportunity. The other side of it is you have to have room to create the opportunities. You have to be disciplined enough that when your position size hopefully grows because of price appreciation and becomes larger than the return and conviction level justify, that you trim it. And when you're on the board, sometimes people ask, are you willing to sell your stock when you're on the board? And we have trimmed all the companies and ultimately sold Advanced Drainage Systems, have trimmed TransDigm numerous times, both just to get its position size back in line or trying to figure out when it's either more highly valued compared to other times or to create room for the next opportunity.
We've learned a lot from the management teams that we've partnered with to see how they're reacting to the business. And it's remarkable. The world doesn't operate in market hedge fund time. Management teams who run businesses have different constraints. They think about the business differently. They have different solutions to the problem. And so I think it's made us better investors to see that contrast between how a management team will react and just see all the pieces they need to move and what's in their control and how they manage the people and how they think really long term about the choices they're making in the business and not just reacting to the stock price.
The volatility of stock prices way larger than the volatility of the operating performance of the business. It always amazes me when you look at some of the companies that are now multi-trillion-dollar companies, when they move 2 or 3%, that's more than the value of most of our other companies in total. When we see these stock price moves, it's usually an overreaction one way or another. Going back to private equity, I've always been surprised. Private equity is usually a really well-informed seller selling to someone who can become a pretty darn informed buyer. And so you don't see too many crazy prices. In the public markets, first of all, it's an incremental stock sale. No one's buying and selling the whole company. And it's usually, people are often selling for reasons that have nothing to do with their view on the company. They either may have some redemptions, they're buying because they have some new money to put to work, or different things. And so we've seen crazier prices on both sides by far in the public markets than I think you tend to see in the private markets.
If you think about the last 10 years in public market investing, the types of businesses you typically describe with this private equity mindset in the public markets often haven't included the Mag 7 that have driven the public markets. I'm curious how you've thought about that set of opportunities.
When we first started, we probably had a presumption, and I think some of our investors had a presumption, that our diligence skills would lead us to small cap stocks and unearthing these little gems that were misunderstood. We hope to do that, but we also found that our quality focus and our long-term focus led us to little bigger companies that had risen above the fray in some ways and differentiated themselves. I remember when we first bought Visa back in 2010, a number of people said, that's too big a company. How can you explain why you own that? And the response we have given, and we still give today, is, look, we told you our rules. Can we understand it? Is it a long-term winner? Does it give a good return? When we start adding, what will people think, we've made the game way too hard. And so we've just avoided that. We stick to those 3 rules. And if we can answer those questions with conviction, we'll invest.
We own a couple of the Mag 7. Amazon and Microsoft are the ones we've been comfortable enough to get conviction and invest in. Amazon's a super interesting one. We actually didn't begin by trying to invest in Amazon. It was a research project. We, as a firm, have invested in brick and mortar retail businesses over our entire history. We have a huge investment practice in digital infrastructure. So things like data centers, fiber, wireless towers. And so we were running into Amazon regularly in 2015, 2016 timeframe, either as a major threat to some of our investments or as a major opportunity. And so it was really important for us to learn to understand Amazon. And as a result of our broad network, it turned out that we had really deep insights into Amazon. Because we're competitors, because we're suppliers, because people in our network have been competitors and suppliers, we felt like we could understand it extremely deeply. And so that's how we started our investment in Amazon. It turned from how can we learn about Amazon in order to go back to doing what we were doing before to actually, let's just invest in Amazon because this is a great expression of our core investment beliefs. A number of the Mag 7, we just find it hard to get conviction in those businesses because they're just outside our circle of competence. They're not in areas that we think we can understand deeply or where our conviction won't be shaken in the event that there's significant volatility. And so while, let's say, a company like NVIDIA is an extraordinary business by all accounts and one we've looked at, we just don't think we would be a great owner of that business at this point in time because while I can tell you all the great things about NVIDIA, I don't know how deeply I believe them because we don't understand it as well as we need to.
What causes you to sell a name in the portfolio?
Well, there's three reasons that you sell. One is you lose conviction in the thesis and you think you should move on. Two is it gets so expensive that you think the returns looking forward aren't acceptable, or at least certainly compared to what else. Or three, you need to make room for something. And that's an important one. We love having a continual flow of new ideas to put pressure on names in the portfolio. So when we get a new idea that people are excited about, because we want to have a minimum position size, that often forces a name out. So we'll sell for any one of those three reasons.
There's an element to which, as you describe this process, like an elegance to the long-term hold and allowing compounding to work. Where have you found that you've made mistakes and could improve?
A systematic mistake that we're always trying to work on is understanding how some businesses can outperform and making sure that a Excel-based valuation methodology doesn't really capture the full distribution of outcomes. A good business with great tailwinds and a great management team can create their own luck. And it's hard to model that. Rob mentioned this earlier. We started off with a very IRR-based framework. So 18 was by definition better than a 14% IRR, or a 25 was by definition better than a 22. That's not the way it works in the real world. The real world doesn't live in a spreadsheet. Companies make amazing acquisitions, or they do really dumb things, or there's disruption that happens in the world. And so just understanding there's human element, a luck element, a change element to investing, and appreciating that that needs to factor into your investment process is probably the source of our biggest set of mistakes is, hey, the IRR says X, we should sell. So selling winners too early has been a constant source of frustration, one that you can just open up your Bloomberg and see it hit you in the face every single day.
How about behavioral mistakes?
I remember one trade in 2016. Fortunately, we were quite small as a firm then, and we seemed to be getting whacked daily with bad news. And for a whole variety of reasons, we made one small trade that I think was emotion-based. Within hours, you realized it. In some ways, I'm happy we made that trade because you learn your lessons from mistakes. And we haven't really done that since, I don't think. It also showed the value that day of having really great partners and long-term committed partners. We received a phone call from our largest investor who follows our portfolio and so had an idea of where our portfolio stood at that point and asked if they could put in more money, which was a huge boost, a show of confidence in us that I think was at a very needed time.
So both of those examples are examples of effectively being right long-term, but selling too early or getting emotional and selling. How do you balance being stubborn and wanting to buy more versus a situation where you're just wrong?
We certainly have been wrong in our history, or we have decided we were wrong. The fascinating thing about investing in the public markets is, in some ways, you never know if the judgment you made was good or bad. Investing's ultimately predicting the future, and the future is obviously very uncertain. My analogy has always been, if you have a coin that flips and 9 times out of 10 it's going to flip heads and 1 time out of 10 it's going to flip tails, if you choose heads, which is obviously the wise decision, 1 out of 10 times you're going to appear to be wrong. At the same time, you have to recognize that sometimes you might choose tails and that was the wrong decision, and it could either come out heads or tails. And so that's why if we start to lose conviction, we have to be quick to decide that we got it wrong and if we have something better to invest in. And so you move on. And moving on is often important in sticking to your guns unless you have really high conviction. Then if you have really high conviction, you stick to your guns until you don't, until it gets shaken. So that's how we try to handle the situation.
It's important to have evidence in a long-term investment that things are working. That may or may not show up in the stock price, but there's a set of markers along the way that give you confidence that your long-term thesis is right. I think Rob also mentioned a really important point, which is we don't have to be right in every choice. We do a lot of work up front, but we do multiples of that work after we own a company. And just ensuring that we're not holding on to something simply because we did a lot of work and we have endowment effect and it's in our portfolio. And the ways to do that are, number one, to do a lot of follow-up work and be honest about the thesis and how things are tracking. And the other one is we're always out looking for other companies. So we don't need to make money with things that are in our portfolio today. We love putting pressure on our portfolio to go out and look for something that's better and comparing it to what's in our portfolio today. We think that process has worked reasonably well. We try very, very hard not to be emotionally attached to any one company.
I'd love to circle back in the current environment to a place when you started Stockbridge. You noticed that public market valuations had gotten cheaper than private markets. We've now gone through this period of time, certainly the last couple of years, just until recently, where there's been an insatiable demand in the private markets and valuations are going up. How do you look at that contrasting of the two going forward?
I think public markets and private markets in some ways are starting to blur a little more. Private markets have grown so dramatically over the last decade that they have become a really significant part of the world's economy, and assets continue to flow into private markets. And there are a number of companies that want to stay private for very good reasons. They don't have need for a lot of capital. There's a lot of headaches that come with being a public company. So I think there's going to be great opportunities on both sides. And the key is we're excited that at Berkshire, we have both the private equity group and Stockbridge to take advantage of the opportunities that arise. I don't think we will make market-based bets of now's the moment to invest in public and now's the moment to invest in private. I think that each group just sees that there's plenty of opportunities ahead.
As you look back at this last nearly 2 decades of investing in the public markets, what are the biggest lessons you've learned along the way?
One of the biggest lessons that I've learned is that investing is about predicting the future. So there's no set of analysis that will give you an answer. You have to take all the analyses as inputs, but then you're ultimately making a judgment about what's going to happen down the road. Another really important one is that you need to invest with conviction. It's really hard to do what we do and be waffling. That's why we demand unanimity among the senior people to invest in something, because you're going to get hit with a bump. And so when you get hit with a bump, you have to have enough information, enough belief to evaluate the new information, but be able to stick to your beliefs if they have not changed. And then one of the harder things, shockingly, I think, is we've learned that you need to trust the work. You did the work to make the judgment. Keep trusting that and live by it. You got to keep adding to that work, but ultimately keep trusting the work that you did.
We did a 15-year look back. We had written down a list of the lessons and Rob captured them. One thing I would add is that we're at our best when we make a small number of very consequential choices and really making sure that our process and our decision making is aligned to doing that. It's very easy in this to think about making a shorter term trade or adding a smaller position to the portfolio, but that's not really what we're set up to do. And when we do that, we're more likely to make a mistake. And so what we've really honed in on is just really trying to make a very, very small number of good decisions, because ultimately those are going to drive the bulk of your returns.
I'd love to turn to a couple of closing questions. Maybe Rob, we'll start with you. We'll go back and forth. What's your favorite hobby or activity outside of work and family?
As the father of relatively young children, there's not a lot of time outside of work and family, but I try to keep active, spend a lot of time skiing, working out, golfing, things that get your mind on something completely different to focus on than what's going on day to day.
No.
We love traveling. As a family, I've grown up traveling from literally the day I was born. We hopped on a flight to Baghdad when I was 3 weeks old. And my dad has, I think, been to every country in Asia except for East Timor. And so we've tried to carry on that tradition.
And what's one fact that most people don't know about you?
One fact that people don't know about Stockbridge is actually that one of my partners, Saad Hassan, and I went to elementary school together at the British International School of Cairo in Egypt. And we didn't actually know that when he joined in 2011, that we were having drinks at a bar next to the office. And I just asked him, where are you from? And he said, well, I lived in Egypt for a while. And I said, I did too. What school did you go to? It turned out we went to the same school. We were a year apart. And I went to my parents, held on to our yearbooks. And so I grabbed our old yearbook from the British International School of Cairo in 1986 and pulled it out. And there's a photo of Saad and I as kids back in Egypt in the mid-'80s.
Rob?
I would say probably the thing that people who know me today would be most surprised at is that I still believe my hardest job that I've ever had was when I was a 19-year-old, having finished my freshman year of college. My dad had fast food, fried chicken restaurants. A manager quit on my first day of summer that year, and so I became the manager of his busiest store with two people twice my age as my assistant managers. And it's still by far the hardest job I've ever had, and it taught me that no one should ever have me in an operations role.
Rob, what's your biggest pet peeve?
I'd say in investing, when someone says, we proved it, we have the answer, you don't prove anything about the future. And so I think when someone comes with that, I'm not as very easily convinced.
Oh, no?
Yeah, probably this came out of the fact that our time is extremely scarce. I don't love people who are inefficient with their time. Just lack of efficiency is probably a big one for me.
One more. Which two people have had the biggest impact on your professional life?
So one is sitting across from me, Rob. Rob hired me to join Stockbridge. And so Rob and the other partners at Berkshire and Stockbridge, from an investing standpoint, I've learned an incredible amount from Rob and my other partners. The other group is we're pretty close to our managers here. And I've spent almost my entire career in a consulting or an investing role on the outside looking in. And just watching Scott Barber at ADS, Nick Howley at TransDigm, John Kelly, who used to run CCI, they just think about the world and problems in different ways. And we're blessed with being able to spend a lot of time with them. And so it's been really an amazing learning experience to learn about the world, not just as blinking lights on a screen.
Rob?
It's hard to limit it to two. I was very privileged to be at Berkshire early in its history, and we had 5 founders who came together, made a firm where none of them was in charge, a partnership, didn't put anyone's name on the door, and they were incredible examples of both investing, but also how to lead a life. The balance, the integrity, it was how they lived that led to the values that we ended up putting down as a firm, which is that relationships matter, the power of teams, and winning the right way. And their example led to those values that I think we've tried to live by as a firm for a long time. So they were incredibly influential.
Rob, thanks so much for sharing all this incredible experience and wisdom on this path from private to public markets.
Thanks so much for having us.
Thanks.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.